So most financial advisors treat the privately held business like every other asset on the balance sheet. So you own a business, Mike. I sit down with you. I'm the advisor, and I ask you questions like, what's in the brokerage account? What's in the 401k? What's your house worth? What's your business worth? And I treat that business like every other asset on the balance sheet. And that's insane when I think about it from the perspective of, if I'm going to give you quality financial advice, I better know about that asset.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor podcast. On this episode of the show, Jason Early, CEO of RISR, is with me for a conversation that just might provide a roadmap for you and your firm to add hundreds of millions of dollars of AUM to your business. Well, that sounds awfully lofty, Mike. Well, maybe, but here's the thing. Jason and the RISR team are making it easier and more efficient for financial advisors to work with business owners. And when you hear the stats that Jason shares about the concentration of wealth controlled by business owners versus non-business owners, you'll kind of see why I'm so bold on this episode's potential to impact your business. Now, before we get to the conversation with Jason, please do make sure you subscribe to the Modern Financial Advisor podcast on Apple Podcasts, Spotify, Google Play, Amazon, the YouTube, so wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest, hit me up. I'm basically at Mike Langford everywhere on the internet, or you can shoot us an email. podcast@finservmarketing.com. Okay, let's get to the conversation with Jason Early. Well, Jason Early, so wonderful to see you. Welcome to the Modern Financial Advisor podcast.
Mike, I'm pumped to be here. Thanks for having me, my friend.
That is the exact correct reaction. You should be pumped to be here. It's going to be a great day. we were just talking about before we clicked record about how we're both fully caffeinated. I had great long weekends. At the time we're recording, this is right after Memorial Day. So feeling great. Like, let's hit the ground running here, right?
Ready to rock and roll.
That's right. So I thought it'd be a fun way to kickstart today's conversation with a little bit of myth busting, right? Everybody's seen that show, Mythbusters here. And it, in part because we had our prep call, and you busted a myth that I just started articulating something that I had this whole notion that, listen, I think that at a high level, financial advisors understand that business owners are likely to be wealthier than their W-2 employee neighbors and stuff. And however, the challenge for advisors is, hey, listen, I make my money on AUM, and a lot of these business owners don't have any A to M, right? They don't have, they're wealthy asset wise, but they're investable asset poor was something that I just kind of had this. I'm assuming this is the notion. And you're like, nope, myth. So I'm going to cede the floor to you, right? They kick this off. Why is this a myth? What's the real deal when it comes to business owners and their wealth?
Well, I think that you are right, perhaps, in that if you look at it on a percentage basis, right? Perhaps if I own a business, the largest percentage of my net worth is in the value of my business. Very true. Until it's not, meaning for most business owners, the vast majority of their wealth is in fact tied up in the business or in the business, again, on a percentage basis. But every business owner exits their business someday, some way, right? Whether that's transaction and they sell to private equity or third party or whatever, or some strategic buyer, or they transition it to the next generation or to the employees of the business, whatever the case might be. They exit their business. And so at that moment, every wealth manager on the planet wants to manage those assets, right? But business owners, while they operate, actually make great clients just the same. And so I started this little rant by saying, again, on a percentage basis, that might be true. But business owners often have plenty of investable assets along the way, and they've got all sorts of other complexity, right? So certainly they have employees, in highly paid employees at that business that you can get involved with. They have, business retirement plans often that you can get involved with. There's succession planning and risk management that you can get involved with along the way. So again, they've got all sorts of complexity, which makes them great clients while they operate as well. And then, to your other point, I think it's something to the effect of 66% of millionaires own businesses, and 89% of people worth $30 million and up are business owners. And so they're just the best client segment, period, if you are in the financial advice business.
It's funny, and it makes total sense, right? I mean, somebody who has a complex financial life and who is building wealth is going to be a good client for a financial advisor. And particularly as we move into, I think the next phase of the evolution of financial advisors, financial planning is becoming more and more important, right? And the more complex your life is, the more financial planning is necessary. I mean, we say it almost every single time on the show that, most advisors, got to start selling product, right? And the industry has evolved. It used to all be just product sales effectively.
Yeah.
And then it started evolving into having some more comprehensive financial advice, and people are starting to get their CFPs and so forth. But I don't know, I just think it's funny to remind people, like, that's like 30 years old. Like that, what I mean? People only started really getting CFPs back in the 90s, right? They weren't doing that back in the 1980s and so forth. We don't have like 100 years of history of certified financial planners, right?
Yeah, I think that's right on. I think this industry, for better or for worse, is slow to change.
Yeah.
And so comprehensive financial planning has been a tagline or, a theme in this space certainly for 20 or 25 years. And I think that's a good thing, right? I think you've watched the convergence of a lot of different advice delivery models kind of all come under one umbrella, which is comprehensive financial advice. And so to your point, you were talking about, what was once product sales. And so whether that was on the insurance side of the house, risk management side of the house, you would go through a discovery process to ultimately place insurance products, or on the wealth management side of the house, you would go through a discovery process to ultimately gather the assets. I think you've seen those worlds collide, and now you're starting to see in the space other worlds collide. You're starting to see a lot of tax advisory come under the same umbrella. You're watching RIAs acquire tax businesses or tax practices. You're watching tax practices acquire or build out wealth management units. And so, again, I think that's all from market pressure, meaning the consumer wants all of that advice coming from one place.
Yeah.
And so the firms are building out the infrastructure to deliver that. And it doesn't mean you as the advisor have to be the expert in all of those things. Another thing that this industry is famous for saying is, I'll quarterback all of your financial affairs. And I think you're actually starting to see that play out in the market.
No, you're 100% right. And it's really fun to watch this evolution. And frankly, we started this show years ago on that concept of like, hey, many advisors will say they have a practice. Well, and a practice is something you as an individual do, right? That you are the key component of this, but we want to help you migrate to a business, right? Modernize yourself so a business can operate without you. A business has other people who have expertise, who are all bringing those expertises, yeah, there you go, to bear.
It's like the old Michael Gerber line, right? If and I'll screw this up, but it's something to the effect of, if you got a business that depends on you, you don't have a business, you have a job, and it's the worst job in the world because you work for a lunatic.
That's right. Exactly. Yeah. You work for a lunatic, and also you're probably terrible at your job compared to like all the other jobs you could be doing. Yeah. So I think it's so important to shine a light on this. The way that you're doing here is that, hey, look, the world expects more of you. And especially now as we start to inch into the world of AI, and we may touch on some AI related topics here, where there is some anxiety in the advisor world about like, well, what is this going to do for me? It's like, well, people are still going to need advice. They're still going to need to talk to a human and walk through some things. So you turning your lens to people who are dealing with more complexity in their life, who are gathering more wealth, and that wealth might not just be like instant in the form of a paycheck. It might be building a business, and then at some point in time, as you said, I love it. It's true until it's not, right? Like there's a scaling effect in most businesses, right? Hey, when I first started out, I am poor. All my cash is going back into the business. We're working our butts off here, trying to get this thing working. Suddenly it starts turning off enough, spitting off enough cash where I can live a good life, a decent lifestyle. Then at some point in time, as we've expanded over the years, the law of scale starts to kick in, and it just starts spitting off money. right? And it's lots of extra cash. You actually see that a lot. You see wealthy business owners become wealthy out of nowhere. Like, hey, this guy's been hustling, doing his, I don't know, roofing business, landscaping business for years, and it's gradually expanded. And next thing you know, like, did he just buy like a $5 million house over there in that neighborhood? And like, no kidding. And they're doing a European vacation. What's going on? It's like, yeah, he's been busting his butt for 20 years, you know?
Yeah, I think, look, compounding is a beautiful thing for starters. And so again, the longer you do something, the longer time you give it to compound, and that starts to pay off. I think that what you're saying is something that we impress upon the advisors on our platform all the time, which is, again, every business owner exits their business. Yeah. Most don't transact them. And so you don't read about in the paper that they sold to some big strategic, or, they went public, or they sold to private equity. That isn't the outcome for most business owners. So what is? It's typically, again, either transition to the next generation, a transition to employees or management buyouts or things to that effect. Or again, some local market, small market type competitor or something like that, or strategic buyer in that arena. To that end, the best advisors take that business owner that you're talking about that's got a couple $1 million EBITDA roofing business, and they help him or her think about what the path to exit or transition looks like. Meaning, what are you doing with that $2 million of EBITDA every year to either continue, because to your point, early on, you're investing it all back in the business. At some point, you might not be. And so what are you doing to build, the retirement nest egg, if you will, that if you were to stop operating your business tomorrow, you can sail off into the sunset or go spend time on the beach, whatever it is that you want to do. And so how are you using the cash flow of the business to fund your retirement plan? Yeah. And so the best advisors understand the priorities of the owner and build them, or show them the path to exit, or build them a succession plan based on those priorities that aligns the goals of the business owner to the outcome. And while that sounds incredibly simple, if you look at how most owners exit, oftentimes it would not align to a stated goal. And so that's the disconnect that we see in the market. And I think, like traditional financial planning, business owners have this additional layer of complexity because they own this powerful asset that makes up such a big part of their overall net worth, like you talked about. Yeah. And, it makes sense that a business owner would need guidance, right? Because we could stick with the guy who started the roofing company, right? Like, he probably started out, as an apprentice somewhere. Like, he started working construction and doing it. And then next thing you know, he's like, I might be able to do this on my own. Right. So he goes out, he gets a client or two, and he hires a couple of workers or whatever. And, it grows gradually. Who knows what that business owner's education level was? If they have a college education, it might not have been in finance, right? Probably not. Right. And so, as they're going, they're learning things along the way, right? They're having their challenges and so forth. And so having a trusted advisor on board as early as possible can help them avoid some of the pitfalls that likely befall many other business owners there. I want to touch on something on the demographic front, because I think this is so important for the audience, right? To truly understand. You mentioned some awesome numbers, right? 66% of millionaires are business owners, and then 80+% of them that are worth 30 million or more are business owners. And that really just makes sense, right? Like, you have to have at some point in scale, right? Very relatively few of our wealthy Americans are the ones who started investing in the stock market, and built their wealth that way. Like, that can be a way to get there over time, but business ownership is just tried and true, right? One of my favorite books, and I've recommended this book, like, it's one of the things I think I've given this book away to people more than any other book. It's called The Millionaire Next Door. And it was written by these two economists who study this type of stuff, Thomas Stanley and William Danko. They studied like 500 American millionaires. And they just look for common stuff. They ask them all, what kind of business do you own? What kind of job do you have? Whatever, like, what kind of car do you drive? And it's a really fascinating and easy read.
But they echo what you said. Most of them are business owners. Relatively few of them are the classic, what you think they are, attorney, whatever professional who, drives a nice car or whatever. They typically drive American cars that are a little bit older. They typically drink, pretty standard beer. They're not out there drinking fancy wines and so forth. They're not wearing Rolexes and that type of stuff. So they're pretty salt of the earth in general in the way that they operate their life. What, that kind of paints a picture of like how you can find who these people are. Like as you're driving around your town, you're likely like, that guy's probably a millionaire. These businesses. What other types of commonalities have you and the RISR team seen in the America's millionaire population or business owner population that might help advisors in our audience better understand how to connect with this segment?
Yeah, I think, and you and I talked about this a little bit. For starters, if you are a financial advisor, regardless of kind of where you sit your affiliation model in the space, I mean, this is more true than others, but you're a business owner yourself, right? I mean, you as an advisor are typically running or operating a business yourself. So one, that is a great piece of connective tissue for starters. Two, the best in this space, the best advisors on our platform, the best advisors in this space go really deep into one or two industries, meaning the old riches and niches. And so they deeply ingrain themselves in a particular industry or what have you, so that they know that industry cold. They know the things that make those businesses tick, and they know how to look for certain patterns and things like that. So we think that's super important. And then to your point, in your own community, like walk up and down Main Street, wherever it is that you live, and all of those businesses are owned by somebody. And so what's super interesting to us is people come onto our platform, like it can be difficult for them to be like, as they start to think about their client roster or their book of business, it's like, how many clients do I have that own businesses? One, it's important to take inventory of that in your own book of business. And then two, are you intentional about the way that you're going to market or the way that you're prospecting or the way that you're engaging with centers of influence, the way that you're doing event marketing, whatever that might look like, having intentionality is critically important. So understanding your ideal client profile and then how you serve them and why you serve them is critically important. And so none of that answered your question. Your question was, is there something that connects the advisor to the business owner? That can be whatever you want as an advisor. Again, is it the community that you operate in? Is it the industry that you as an advisor have chosen to serve?
Yeah.
Whatever that looks like is really up to you as the advisor in terms of how you want to go to market, but having a strategy is the most important thing, not what the strategy is.
I love it. I love the fact that I love the riches and niches segment. I've always loved that phraseology, and anytime you talk about marketing for, well, frankly, any business, but particularly for financial advisors, we often talk about target, having a good target market or a niche to focus on. It just makes your marketing so much more efficient, but it also makes it so much easier for that prospect to recognize you are the right advisor for them. When you go to most advisors' websites, and for the advisors listening or watching, fire up your website and go think of 5 other competitors in your space. Tell me how your business looks different than any of them. We work with wealthy people, help them protect their wealth. We do. It's all the same boring, right? Yep. Frankly, and it tells me nothing about who you serve, right? Yep. But imagine if you did serve local business owners, who built their business from scratch. Maybe you picked a niche like coffee shop owners and donut shop owners, or whatever, local restaurateurs. We'll use that. People who own chains of restaurants, small chains of restaurants. You can get very specific with the language you use on your website and your marketing content. So for instance, as an advisor, you call your customers clients. Well, those people who have coffee shops and whatever, they might just say customers, or if they have, sit down, they might call them diners or patrons or whatever. You can use language like that. You can talk about things like all the ins and outs of hiring or whatever. You can offer content that supports that type of stuff. So I think it's a really smart thing to do, is like get focused on who it is that you serve.
relevance matters.
Yeah.
And this has become, I've become increasingly aware of this when we think about our business. And so we serve the financial advice industry. And so we're in the software business, we're in the technology business. We've got all sorts of differentiators and, high-powered AI technology that really is cutting edge. But where we view our competitive advantage or our, what really differentiates us is exactly what you just hit on, which is relevance. We are crystal clear that our client is the financial advisor.
Yeah.
And so everything we do is from the lens of financial advice. And the more you narrow that down and the better that you understand your customer, and to the extent that customer is like really well defined, the better your business is, because relevance is king in that regard.
100%. You have to be able to see yourself in this. I always tell people, like, one of the reasons why somebody's going to go to your website is to validate you. Like, are you valid?
Yeah.
Are you like really who you say you are? Or are you like, legit? Can I find out if you are a financial advisor? But then I'm going to look like, am I in the right place? Because here's the deal. Every financial advisor sells the same stuff: stocks, bonds, mutual funds, right? Maybe some insurance. They have access to all the same product. They charge about the same price, right? So it's somewhat commoditized from the service perspective and the product offering. How do I know that you're the right one for me? And, eventually it comes down to sitting across a desk or, on a Zoom or something with the person and relating and having some level of comfort with the person. But you can go a long way with letting the person know, like, oh yeah, man, no kidding. They serve people like me, right?
Absolutely.
Jeez, it makes a lot of sense. Now, you said something a little while ago, and I want to unpack it a little bit. We talked about the advisors themselves being business owners, right? Small business owners. And often, however, when you talk to people, particularly in practice management in this space, you'll say, these are accidental business owners, right? Most financial advisors didn't get into the industry thinking they were going to be business owners and have employees and all that type of stuff. They answered a call to become a financial advisor or to become an insurance agent, started selling product, as we talked about before. They grew their book of business to a certain size, and then the industry evolved, right? The industry started saying, guess what? You can break away from that wirehouse and go start an RIA. You can do this stuff. And next thing you know, they've got a business, right? Yet their business doesn't look like a lot of the businesses we've talked about before, right? They have no inventory. They have no real physical assets. Probably relatively little, if any, business debt or outside investors in the business for most. So the cap table is pretty much, I own it, type of thing. They have a recurring revenue stream that every other business can only dream of. Like, as long as I can keep this customer happy, the money just keeps coming, and I don't have to resell them to get to buy more product all the time. It just keeps flowing. And they also don't have transient employees. Like, talk to a restaurant owner, like what it's like to try to keep employees in the place, or a tech owner like yourself. Sometimes you'll see that too, like engineers jumping from place to place or whatever. So I guess what I'm getting at is, I suspect many advisors might feel a little nervous,
guilty, maybe, based on what you just said. It sounds like an incredible business. Where do I sign?
Right, exactly. But I think one of the challenges they might feel is like they kind of going back to what we talked about before. They're accidental business owners, and they really haven't gone through the framework of like, okay, this is what it's like to start a business. This is what it's like to think about all marketing and sales and operational infrastructure and efficiencies and that type of stuff. So they may have a little bit of, hey, I'm not sure if I know what I'm talking about when it comes to talking to business owners. How do you and the RISR team helping to kind of close that gap, right? Like helping the advisor get more confident that they can talk to business owners and help them?
Yeah. So wonderful question. That a word you just used, we think about all the time. And so we call it both a confidence and a competence gap. So a lot of times, you're right, advisors may not have the confidence to target the business owner or to give advice to the business owner. Maybe it's based on the things that you said. Maybe it's based on something entirely different. Maybe it's some of the complexities or the need to be an expert in all sorts of different areas that they're not. This is something that we try and reframe all the time, which is to say the business isn't looking to you, Mr. or Mrs. Financial Advisor, to be a consultant to their business, to help them think about the business owner is looking to you for something that you're already great at, which is give great financial advice. And so in our view, you don't have to reorient around your practice or how you go to market or anything to that end. You do not have to become an expert in their business. You have to become an expert in understanding what their priorities are with this asset. So most financial advisors treat the privately held business like every other asset on the balance sheet. So you own a business, Mike. I sit down with you. I'm the advisor, and I ask you questions like, what's in the brokerage account? What's in the 401k? What's your house worth? What's your business worth? And I treat that business like every other asset on the balance sheet. And that's insane when I think about it from the perspective of, if I'm going to give you quality financial advice, I better know about that asset, right? If it is your most important asset, which for many business owners, 10 out of 10 times that's the case. So I better have a deeper understanding of that asset. And that means financially. And that also means, like, if I'm giving you advice on your brokerage account, your non-qualified brokerage account that's invested in the market, I don't have to do a whole lot of digging to understand what you want that to do, what you want that to accomplish. If it's the business that you've spent, the last 10, 20, 30, 40, 50, 60 years building, pouring your blood, sweat, tears into building it in the community, on and on and on. I could get you talking for days about that. And so from an advisor's perspective, I have got to better understand that asset. But then all you have to do is provide great financial advice around that. And you have to understand how that asset fits into their life plans, right? How am I securing the value that they've built there? How am I making sure that you can use this business to accomplish what you want to accomplish in retirement, in your legacy planning, and your generational planning, whatever the case might be. So that confidence piece is something that we try and reframe you are already great at what you do.
Right.
You do not have to do anything different from that perspective, other than you have to better understand, you have to ask better questions, you have to better understand that asset. And then the competence gap, I'll speak out of both sides of my mouth here for a second, which is to say, you do need the tools and the resources, and you do have to, be intentional, because business owners are two things. Number one, they are complex, and number two, they are incredibly hard to pin down. So you have to be aggressive in going after this market. It's one of the reasons that 65% of business owners don't have an advisor, right? That's a two-way problem. Number one, advisors aren't intentional enough or aggressive enough in targeting this. And two, business owners notoriously give advisors the Heisman. And so you have got to work hard to go after this and be intentional about how you're doing so.
I gotta shine a light on that for a second. 66% of millionaires are business owners, and 65% of that 66%, so let's call it 40% of people, right? It's 40% of millionaires don't have a financial advisor, right? If my math was somewhere in the neighborhood.
The math's getting beyond my pay grade.
I know.
It's a staggering number.
What's 66% of 60? Anyways, but the whole point is, what you just said is a very large number of percentage of millionaires are business owners, and a very large percentage of those millionaire business owners don't have a financial advisor. So number one, take note of that, members of the audience. This is really important.
Mike, this is a blue ocean, right? There was a very popular book, I don't know, 10 or 15 years ago, called Blue Ocean Strategy that advisors loved, which is like, where are you in blue oceans or red oceans? And so this is very certainly a blue ocean, and becoming less so. Right? Meaning everybody is starting to get focused on the business owner, because they are seeing the demographic tidal wave. They are watching all of these business owners transition and transact. And they know that they have to have a strategy around it if they want to grow organically, which is something the industry writ large loves, is talking about organic growth. And there's no better place to do that than with business owners.
Love it. So let's dive into, you mentioned you have to have a strategy for doing this. We've talked a little bit about that. But you also said you have to have the tools. And the tools, you're building the tools, right? So at RISR, you have to have the right tools in order to serve business owners. And it can make your job a lot easier as an advisor to do so, and bring a lot more value, of course, to the business owners who are your clients. So let's dive into how RISR works, because we actually haven't done any of that yet so far. We've talked a little bit about some kind of like, we've set the stage for like why this is important, and we've talked a little bit about almost some philosophical levels type stuff in the scale of the market. So let's dive in. How does RISR work, and how are advisors leveraging the platform in their business to serve business owners?
Yeah. So a couple of things. We've talked a lot about, again, why advisors should be paying attention to this market. If you are now paying attention to this market, to your point, you need the tools and the technology to arm yourself and to attack it. Meaning, for a long, long time, advisors have had the financial planning technology to serve the individual or the family or the household. But to our earlier points, the business has largely been ignored. And so if you believed me all along the way to this point in the show, now you've got to find a way to better understand that asset. And so there's two component parts that are incredibly important. One, obviously, is the financials. And one of the challenges that you have from an advice perspective is business owners have financial data that is disparate, it's disorganized, it's all over the place, and it can be very difficult to pull in and analyze. And so our system does that, right? Which is uses AI to pull in financial data, analyzes that data, and then surfaces a bunch of relevant insights across a whole host of areas that are relevant to financial advice. But the second part, which is perhaps more important, is all of the qualitative stuff, which one helps us as a business form insights on specific company risk and things like that, but then helps hold up a mirror to the business owner to help them highlight and understand the operational risks of the business, be it customer concentration or owner dependency or key people risk or vendor diversity, all these different things. And two, get the advisor pulling out of the business owner their priorities and their goals and their hopes and their dreams. So we offer a whole host of insights across things like valuation, wealth, risk, succession and exit planning, all of those things. And so what's really important is to understand where you are today, which is critical. But more important in our view is where you want to go. And then how do I bridge that gap? And so from an advice perspective, every advisor listening to this show will understand that, the financials are important and the numbers matter. But what really matters is being, the best advisors ask the best questions and get the business owner talking about what's most important to them. That's where trust is built. That's where advice is delivered on areas like that. And so we think that that's really important. And we think that there is a real, one of the most powerful things in our view is helping the business owner think through their path to exit.
Yeah.
Meaning, to the point we talked about, the demographics are such that all of these baby boomers that own businesses are transitioning and transacting. And oh, by the way, there's other market forces that are driving this up, which is, it is more in vogue than ever to own private companies. Mm-hmm. In fact, the single most applied for job from Stanford Business School, Harvard Business School, Wharton Business School, and Northwestern's Kellogg Business School. Guess what it was, Mike?
CEO of a private company?
Ostensibly, meaning Alpine Investments is a private equity firm that has a CEO and training program. So they operate in the lower middle market. They obviously have seen this demographic shift. And so they go and invest in businesses with, I'll screw up what their criteria is. It doesn't matter. But it's effectively owner-operator-led businesses where the owner wants to retire. And what Alpine does is they have a CEO and training program, and they bring MBAs who are highly motivated, smart, talented, whatever. And so they bring them into their training, and then they place them as CEO of these private companies that they acquire. And so your answer was exactly right, which is CEO of a privately held company. And so for, hundreds of years, that the answer to that would have been a consultant at McKinsey or Bain or BCG or whatever it would have been, or an investment banker, or on and on and on. My gut is that for the first time, that isn't true. And so I think that was true in 2022, and it certainly has been true over the last couple of years. So it is more in vogue. I say all that to say it is more in vogue than ever to own private companies. People are trading in and out of these private businesses with much higher frequency. And so they need advice on the way in, they need advice while they operate, and then certainly they need advice on the way out. And so, RISR as a platform supports that from a financial advice perspective. So anybody that's in the advice business that is working with business owners, you need the tools and technology to enable that, and that's where we sit.
I love it. It's funny. Years ago, I was speaking at a conference of I can't remember which broker dealer it was, but it was one of their top performer conferences. And they came in, and at the time I was consulting on social media usage for wealth management firms. And so the company brought me in, and give a speech on social media and why advisors should be using social more. And then after, one of the guys with the advisors who was there came over and started chatting me up because he wanted to talk about targeting business owners using social media. And he's like, we've transformed our business. He's like, for years we kind of plateaued, and I'll butcher some of the numbers here, but he's like, we were at about 100 million AUM. It was just, relatively small firm, whatever. And it's fine. He's like, but I just decided I want to grow this thing. I'm tired of working with smaller clients. I want to grow. So he went out and did some analysis and found okay, I want to find businesses that are worth $50 million or more in my geographic area. And I want to try to find out ages of the owners. And so he did that math, and he's this is, again, 2011, 2012, somewhere in that neighborhood. So we're, still internet enabled, but they created these reports that were leather bound reports and everything, sent them out via courier to all these business owners and said, here's what we think your business is worth based on our analysis, just high level. We haven't done any deep dive stuff, whatever. We would love to help you find a liquidity partner for this to sell this business. We'll do that for free. We'll help you with that. The only thing we ask is that if you sell the business, we get to manage money. And he goes, Mike, we 10x the size of our business in a decade doing that. I was blown away. I'm like, this is amazing. And this is not an uncommon thing. I had this guy, Tim Vorhoff from Creovallo, which is a business broker / investment bank that focuses only on working with financial advisors to help, find small business owners to, help sell their businesses and so forth. It's a very similar model. I had him on the show, I think late last year or whatever.
Tim and Creo. I know Tim and Creovallo.
Oh, you do? Okay.
They're awesome, very smart people. And if my memory serves, Tim's like an ultra marathoner.
Yes, he is. Crazy talented.
So, he runs outrageous amounts of miles, and so he's very impressive in that regard.
I teased him.
They curate investment banks to help advisors find the right investment bank to bring that business to market. So love what they're doing, and they're great people in Austin, Texas.
Yeah. I teased him. I said, listen, dude, what? So you just think you're better than regular marathons? I mean,
anyway, which is so foreign to me as a concept. The thought of running that far,
running for 26 miles seems bad enough. They're going, I like to stay in shape, but that's just not for me. But anyways, so you've touched on it a little bit as it relates to RISR in terms of talking about this concept of hey, eventually you're going to have an exit, right? And I would say, hey, financial advisors, same thing, right? At some point in time, you will stop doing what you're doing. Either Father Time will tell you it's over, right? Or you'll sell the business, or you'll have an internal succession plan, or what have you. What role does RISR play, or how do you help advisors and their clients plan for succession or potential exits? Or what is there something in the technology that you work with advisors and clients to do so?
Yep. So advisors will license our technology and white label it to be able to do several things. And so number one is value the business, right? So you got to understand the value of the business today. Number two, which is what we call the dream value or the wealth experience, which is to say, to the earlier point, great, Mike, your business is worth $10 million, but based on everything you told me, retirement income, legacy, philanthropic, all these other things, the business needs to be worth 20. So what are the levers that you can pull to increase value in the business? What are the risks that your business faces? Things like that. Certainly from a risk management standpoint, we think about it in a couple ways. Number one, as an owner, you have built this valuable business. Have you protected the value that you've built, either via buy-sell agreement or whatever it might be? But two, what are the operational risks that your business faces. And if you de-risk those things, how does that impact the value of your business? Meaning, again, if your business, we hit on a bunch of these, if your business depends on you as the owner, it isn't that that drags on the transferable value of your business, right?
Yeah.
Business owners typically, they almost wear it as a badge of honor. Like, oh, the business depends on me. I've got all the relationships.
Yeah.
Boom, boom, boom. Well, guess what? As great as that probably is for your ego, it's not great for the value of your business, right? So eliminating yourself from the business in that regard is critically important. So it helps you identify and talk through all those things. And then to the other point that we talked about, it helps you understand and pull out of the owner the priorities that they have for succession and exit, and then serves up both a business owner, a business readiness score, how ready is the business to transact, and and a personal readiness score for you as the owner. How ready are you as an owner? Because again, this is a highly, highly emotional asset. You are not emotionally tied to your brokerage account or your 401k account or other assets. I mean, oftentimes you are emotionally tied to your home. Your business is 2, 5, 10x the emotional connectivity to your home. And so helping the owner understand that, and then based on their priorities, we'll serve up a path or a guide to exit. Meaning, should you be like exploring a succession plan to the next generation? If it is most important to you that your business continues and that your son or daughter operates it, serving up a path to exit of selling to third party or some strategic buyer obviously isn't relevant. So helping the owner understand what's most important from a prioritization perspective, and then serving up paths to exit. So really a succession and exit planning deliverable is super important.
That's incredibly powerful. I mean, you think about, I would imagine in many cases, business owners never had that conversation with somebody. I've always joked that, many times the first time a couple is having a conversation about future life goals that relate to money is when they sit down with an advisor for the first time. They start talking about what kind of college experience would be the right one for our kids, or where should we retire? And one says Florida, one says Southern California. I don't know. Also you're like, wait a minute, hold on a second. Those are two different things. I imagine this is similar, right? The first time these business owners are starting to have these conversations is with an advisor.
Yeah, which isn't happening enough. And so you're totally right. So what ends up happening? To your point, most owners are accidental owners. So I'm a baker. I open a bakery. I operate a bakery for 30 years. And then one day I say, that's it. I'm gonna retire or I'm done. And so hopefully you've built this valuable business that you can then say, okay, if I don't have a succession plan internally, or I'm not going to, maybe I will sell the business. If you wake up one day and make that decision, the market's going to be crystal clear with you on what that business is worth, right? Like willing buyer meet willing seller. And so the market will dictate the value of that business. To your point, the advisors are trying to get there years and years prior to help them understand the priorities, but okay, what's the value of the business today? And then how do I impact, what are the value drivers? How do I impact the value of this business? How do I drive down risk and increase, oftentimes it's as simple as earnings and revenue, right? Drive value. So how do I understand what the levers are that increase value and the risk that the business faces so that I can deal with that? And then how do I align my path to my goals? And so that's what I say when far too often the outcome doesn't meet stated goals and objectives. And because to your point, they're not stating their goals and objectives. They're operating the business. And then one day they decide that they're done and they're at the whim of, is there a buyer? Yeah. Are there is there a team that can, just start operating this business to continue the business if I just want to go away? You are at the whim of the market or your business and your team. And it's too important. It's far too important. And advisors that want to do what your buddy that came up to you after your speech did, which is 10x their business or 2x their business, or if you have growth goals, you can't ignore the business owner.
Yeah. It's so funny, there's a cliche that people say, when they start talking about business and growing your business and so forth, you have to work on your business, not just in the business, or you have to actually think about the strategy or your goals for the business or whatever, how is the business operating versus, just going to work every day. And in the case of the baker, time to make the donuts type of thing, the old Dunkin' Donuts commercial. But having a regular conversation with your advisor, likes to say, even if it's once a year, and it involves talking about the business, your future goals for retirement, succession, or whatever, how's the business doing? Like having that conversation in the framework of this is an asset for my life. It's not just my job that I do, that I happen to own the business, right? Like that's a different framework. I think it's incredibly powerful.
No doubt. And certainly we agree. So to the extent that we can get advisors thinking that way to create better outcomes for the businesses that they serve, and that it's no charity, right? Meaning it creates great outcomes for them just the same. So we think a lot about how to help solve the problem for advisors, and one of the great things about that is it creates much better outcomes for the businesses that they're working with.
Yeah. So I know we only have a little bit of time left with each other, but I want to tackle a couple of other things that I think might be really interesting, at least at a minimum, but also potentially incredibly valuable for the advisors. And one is some of the other hidden benefits of working with business owners for advisors, right? So, one that immediately jumps to my mind is many small business owners, privately owned businesses, are family businesses. And if they're not family businesses, the family's kind of involved at some level. They might be on the board. They, in many cases, are probably at least a shareholder, and have some form of stakeholder relationship in the business. And in the industry, the wealth management industry, you can't attend a conference or listen to any type of messaging from a large broker dealer that doesn't say you've got to connect with the next generation with your clients. Heirs matter, because you don't want to wake up one day and find out your client passed away and his heirs had no relationship with you, and away goes the money, right?
Yeah.
This feels like that feels like one of those extra benefits, right? Like working with a business owner means you'll probably develop deeper relationships with the family and so forth. You can examine that, but also, like, are there other benefits that you're seeing, like, that working with business owners provide for the advisor?
The single greatest benefit in our view is, we talked about business owners have complexity, but complexity means opportunity from an advisor's perspective in terms of advisors are paid for the size of the problems that they solve. Well, business owners have a whole host of problems. And so there's only a couple ways for advisors to grow their revenue, right? It's sell more stuff to their existing clients or get more clients.
Yeah.
Right. There's two ways. And so to the extent that you don't want to have thousands and thousands of clients, you better be able to solve a lot of problems for the existing clients that you have. And so business owners, we touched on this a little bit, but certainly there is working with the owner, him or herself. Then certainly when you go to kind of key employees or executives inside of that business, there's personal planning opportunities there. There is key person planning for the business, right? Like, are you protecting the key people inside of the business? Are you, the 401k plan for the business or the retirement plan for the business? Like, there are so many problems that you can solve for a business owner that just working with Jason and Molly early don't give you, like, you don't have that type of optionality or those many. There's only so many problems that you can solve for us personally, if we're W-2 employees. And so I think that is I think that's the single greatest benefit. Yeah. Like everything in life, that comes with the trade-off. What's the trade-off? It's hard. It's hard. Yeah. Working with business owners is hard. They do have complex problems to solve. They're notoriously hard to pin down because they've got it all on the line. Like, they are worried about their business, and that's it. If I work for ABC Corporation or what have you, and I punch in and I punch out, I have all the time in the world outside of there to think about my financial plan. If I'm an employee, if you're the business owner and you're worried about making payroll and you're worried about all the things that can go wrong, it is hard to pin you down to go through financial planning exercises. And so to that end, again, that's one of the trades. It's hard, and they typically trust at a lower level. So you have got to find ways to build trust with business owners. And so again, we think that there is an ecosystem play here, which is to say in the financial advice space, they talk about centers of influence. And so who else is surrounding the business owner? It's the accountants, it's the attorneys, it's the M&A folk, right?
Yeah.
Are you building deep relationships with those people to work on borrowed trust? Meaning, if you are the most trusted advisor to that business owner, can I leverage that because you trust me? And so early on, that will help me with speed to trust, to build that relationship and so on. So I think that, look, there's all sorts of benefits, but you can really almost create many little flywheels there, which is to say, I work with this business owner. There's all sorts of people that surround that business owner that can get me to my next 10 business owner clients. And that doesn't always that doesn't always exist outside of that space.
Yeah. Well, at a minimum, like you said, the complexity means more service, right? The network business owners know other business owners, right? So you're going to be serving that business owner and helping them solve their problems. Chances are they will talk. So that's amazing. Last question that I wanted, and it just popped in my mind. I pulled together these prep docs and so forth, and I started to think about the narrative, the conversation we're going to have, and then it dawned on me that we didn't talk about in the prep call about solopreneurs. They're business owners, but it's just them, right? And this is an increasing. Actually, I had no data to back this up, but I'm going to go ahead and claim that this is a growing segment of human beings because it's never been easier to start a business and have it be one employee who might use some contractors or services that are online or whatever. Heck, many of the advisors listening are probably solopreneurs, right? They have no actual employees beyond themselves. What are you seeing in that segment? And is this an area that you're seeing with RISR that you have to have a little bit of nuance to work with? I mean, obviously no employees, but like there are some different thought processes happening here, right? Like the business doesn't exist without them. It is them, right? They're a solopreneur, but they still are business owners, right?
Yeah, no doubt. I don't have a ton of thoughts on the nuance around it. Typically, again, if this is the case, if I'm a solopreneur, it's probably less complex than a business that has many employees or whatever the case might be. The reality is, I'll screw this number up, and so maybe we put it in the show notes, but like call it 70+% of businesses privately held companies have fewer than 10 people. And so it is a huge swath of the privately held companies that power our economy, that are, again, up and down Main Street, that have fewer than 10 employees. And in this case, you're talking about no employees or one employee. So again, I just think it goes to technology is enabling this. More people want to own businesses. And so oftentimes those will start as like side hustles.
Right.
Someone is using their knowledge to provide some sort of service and test that until they can kind of break free of whatever it is that they're breaking free of. And so, look, we think that business ownership is a beautiful thing, and hopefully they're providing a great service. And everybody, all of these people need advice. And so to the extent that the business is successful, the person that owns that business, not only is it their income, hopefully it is building some sort of enterprise value, and they need an advisor to help them think through how that fits into the rest of their financial plan. So I don't know that it's all that, different based on employee size. Again, I think just like anything, the complexity grows as the size of the problem or the size of the business grows.
Yeah. I love it. Well, it's been a fantastic conversation, Jason. RISR.com, RISR.com is the website. We'll make sure we get that linked up in the show notes. How can people follow along with you? Where else can we find you? You're on LinkedIn. You're active there. You're doing any other awesome stuff out and about in the world that people want to follow along with?
Yeah, thank you. We spend, we're certainly, you can find both me and RISR on LinkedIn. We are active there. We spend an awful lot of time playing in traffic where financial advisors are. So be that out in the marketplace at conferences and things like that. And other than that, the website's a great place to stay tuned on what we're up to. So appreciate it. Yeah, really enjoyed the conversation, and grateful for what you do for the industry.
Appreciate it. Well, thank you for coming on the show, sir.
You got it.
Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge props to my man, Jason Early from RISR, for coming on the show and sharing those amazing insights, right? They're really kind of eye-opening when you think about 66% of millionaires own a business and 88% or so of people worth $30 million or more are business owners. It's pretty fantastic. So, sounds like you got some to-do list stuff to do. Go out and start talking to business owners, but make sure you have RISR in your back pocket to do so. Awesome, awesome stuff. As I mentioned at the top of the show, please do make sure you subscribe to the podcast on your favorite podcast platform. And, make sure you be nice to each other. We will see you next time on the Modern Financial Advisor podcast. See ya. Bye.